Alright guys, let's continue with the revision session. In the last session, we have seen it till step 4, right? Now let's look into step 5. Fadafat will go. Anyways, what is step 5? The last step is recognizing revenue. That's obviously. Now the question is how to recognize the revenue. Very simple. Whenever a performance obligation is satisfied, in shortcut we call it as PO. When PO is satisfied, at that particular point of time, you have to recognize the revenue. Now the question is why PO satisfaction is very important, because when I say PO is satisfied, it means control is transferred, whether in case of goods or in case of what, services. So when I say PO is satisfied, it means control is transferred. So when control is transferred, PO is satisfied, and thereby you can recognize the revenue. This is what you got to remember. Okay, now the next question is, okay, fine, PO gets satisfied only when control gets transferred. Now the next question is when transfer of control happens. Obviously, that is why we're going to discuss transfer of control. Now transfer of control can happen two ways, either over a point of time or over a period of time or at a point of time. Now the question is, over a period of time means what? This is important because over a period of time is specifically given. So as you can see the criteria, if any one of these conditions it fits in, then your transfer of control happens over a period of time. It is specifically given. 3 scenarios. If your transaction does not fit into any of these 3 scenarios, automatically it becomes at a point in time. If none of the above criteria apply, revenue is recognized at a single point of time. Are you able to understand? So which means the definition for transfer of control at a point of time is negative. The definition for transfer of control over a point of time is specific. 3 specific situations are given. If your transaction fits into any of these situation, any of this scenario, then transfer of control happens over a period of time, which means PO gets satisfied over a period of time, which means revenue should be recognized over a period of time. If it does not fit into any of these criteria, your so-called transaction between the customer and the entity, then automatically transfer of control happens at a point of time, which means PO gets satisfied at a point of time, which means revenue has to be recognized at a point of time. I hope this is clear. Yes? Alright, fantastic. Now, let's look into these 3 specific scenarios. Customer simultaneously receives and consumes benefits: cleaning services, payroll processing, maintenance, cable TV, security. This particular point we have already seen in step 2 when we were looking at the definition of PO, right? There are certain services where you'll be doing the same service again and again over a period of time for a whole year, like Netflix subscription or cleaning services, pest cleaning, whatever it is. Sorry, not pest cleaning, housekeeping. Okay. Now the point is, because they do the same thing again and again over a period of time. So every single day you can't call it as a separate PO, right? So therefore we said that the entire year will be taken as a one single PO. So we are talking about pretty much the same kind of a scenario where customer simultaneously receives and consumes benefits. Netflix subscription is there. You consume the benefit every single day, na? The service is getting received by you as and when you watch, right? Same goes with payroll processing, same goes with maintenance, same goes with cable TV. Now nobody is using it. Anyways, same goes with security services for your apartment. Got it? Right. So this is very easy. Nothing much is there in this. These two are relatively important. In this specifically, the B point is important. Let's try to understand what is B point. Okay, we'll do one thing. B point will come at last. First, let's cover C. Asset created has no alternative use to the entity, and the entity has right to payment for work done. Sir, what is this, sir? I'm not able to understand. Very simple, Hannah. Sometimes you try to do customized service or customized any construction services for a particular client, for a particular customer. Now when you're doing customized services or customized any sort of a thing that you're building which is customized, there is always a risk that if the so-called customer tries to cancel the contract midway, then whatever the work that you have done goes waste, right? And you have to recover the cost that you have incurred. So thereby, in these kind of scenarios, there will be a particular clause which says that in case if there is cancellation on behalf of the customer in the middle, then whatever the cost that I've incurred so far as an entity plus a little bit of profit margin on that should be compensated. So because of this clause, because of this condition, this scenario, this particular transaction, customized building of services or goods, whatever as the case may be, falls under transfer of control over a period of time. I'll show you an example. You can see here. Just a second. See, Rana. Infosys builds customized payment software for SBI. Okay, highly customized for SBI system. So which means it cannot be sold to anyone else. Okay. There will be a sentence in the contract between Infosys and SBI that if SBI cancels the contract, because SBI is the customer over here, midway, Infosys gets cost plus a little bit of margin. Because of this, control is transferred over a period of time, not at a point of time. You understand the point? Because of this condition. Therefore, what you guys need to understand is that it's a specific scenario, it's a customized scenario. The moment you see such a kind of scenario in the question, you know that, okay, transfer of control is happening over a period of time, which means your PO is getting satisfied over a period of time, which means revenue has to be recognized over a period of time. That's it. Now, what is important for us out of these three is the second one. Customer controls the asset as it's created or enhanced. For example, construction contracts. Based on this only, we have all this input method, output method, and all that stuff. We'll see that. Now, let's get to the example. Look at the example, Nana. So, for example, L&T builds a particular warehouse for Amazon. So, L&T is the entity, Amazon is the customer. Okay. Amazon supplies design, but at the same time, Amazon owns the warehouse under construction, correct? Right? L&T's job is just to build. And for building, it will get something from Amazon. But who owns it eventually? Amazon, right? So that is the point that we have written here. Customer controls the asset. Amazon controls the warehouse as it is created or enhanced. Got it? Chalo. All right. Now, if any of these three specific scenarios, if your transaction doesn't fit in any of these three, automatically it will be what? Considered as transfer of control at a point of time. There ends the matter. Now, let's focus on these areas. Okay. So, in these two scenarios, basically what's happening is that you are actually constructing big projects, right? So, when you are constructing big projects, and we have already seen here that transfer of control happens over a period of time. As a result, PO gets satisfied over a period of time. As a result, revenue has to be recognized over a period of time. Now the question is how to recognize the revenue. Now you can't recognize obviously the total revenue. So you need to recognize revenue based on the percentage of work completed or the measurement of progress, which we can call it in other words. Now the question is percentage of work completed, how to find. For that, we have two methods. This holy trinity already I told you, right? Output based method, input based method. These are all the two methods that we have got to find out percentage of work completed. Now the question is, what is the difference between output based method and input based method? Very simple, Anna. Output based method means you are trying to calculate the percentage of work completion from the point of view of revenue creation. Okay, revenue creation. So cost plus profit, that particular point of view. When it comes to input based method, this is purely based on cost. If you look at the formula also, you'll understand. For input based method, it's very easy. Percentage of progress is what? Cost incurred till date divided by total estimated cost. Very simple logic, na? If you're estimating the cost to be 100 CR and you have incurred 30 CR so far, 30% is what? The work completed, I mean percentage of work completed. Although there are a lot of twists and turns here that we will see later. Right now, this is the basic idea, correct? When it comes to output based method, what is the situation? It's from revenue point of view. If you can see, fair value of goods or services transferred. What do you mean by fair value? It includes the profit margin as well, divided by total fair value. That is nothing but market value into 100. So in a way, this is cost incurred till date divided by total cost that I'm expecting to incur into 100. Here, revenue that you have earned till date divided by total revenue you are expected to earn. In a way, it is like that, right? In a way, it is like that. Please try to understand. I don't know whether you are able to understand my sentence over here. Anyways, now you can ask me, why is that they are going with fair value of goods or services divided by total fair value? How can you find fair value? See, fair value you can find only with respect to output. That's why it is called output based method. Now the question is, what kind of output? That's what example I've given in brackets. Units delivered, milestones delivered. Sir, can you give me examples so that we can we can understand output based method? All right. So I'll just go with few examples over here. See here. You need to understand what do you mean by milestones achieved. Okay, for example, L&T is the entity. Okay, it builds metro station for government. Who is the entity? L&T. Who is the customer? Government. Okay, now in the contract, it has been mentioned clearly by the government that I'll make you payment based on the milestones that you achieve. Now the question is, what do you mean by milestones? For example, foundation completed. Government promises that in the contract 20% of the value will be given to you of the total value. So here we are talking from revenue perspective only, or in a sense fair value perspective. So it is not from cost perspective. That's what you need to understand. Structural framework, if it is completed, I'll give you 30% of the value. Utilities or roofing is completed, I'll give you 30% of the value. Finishing or commissioning is done, I'll give you 20% of the value. Now this is what is there in the contract. Now let's say in reality, say after 2 years, foundation is done, structural framework is done, which means Relatively, how much percentage is done? 20 plus 30, which means 50% is done, which means 50% will be transferred, which means it will be considered that 50% of the work has been done or 50% progress is done. You understand the point? Got this? Okay, one more example. PK Limited is a contractor. In the contract, it is like this. Design, if it is done, I'll pay you 20 crore. Supply equipment, 50 crore. Installation and commissioning, 30 crore. Total fair value is 100 crore. Till today, if you see, design part is only completed. What is the fair value of that? 20 crore. So 20 crore divided by what is the total fair value of the work? 100 crore. 20% is the measurement of progress of work. That's all. Simple. Is that clear? So I gave you this examples only to understand the wording over here. What do you mean by output based method? It can be units delivered. It can be what? Milestones delivered. It can be anything. That's why the word used is output. Anyway, from problems perspective, this is not that important. Input based method is important for us. Right. One more sentence I've written here. Goods or services transferred to customer as of today relative to total goods or services promised. However, we talk from the point of view of the fair value, which obviously includes the profit element. Here that profit element will not be there. We talk from the point of view of only what? Cost. That's what makes input method different from output method. But when it comes to problem solving perspective, which is more important for us, input based method. Okay. When it comes to input based method, what is the measurement of progress? Very simple. Cost incurred till date divided by total estimated cost into 100. All right. It sounds very simple. Yes, it sounds very simple, but there are certain twists. What are that? Exclusions from cost in the above formula. Okay. What are they? Abnormal loss and wastages are not included. They're totally removed. The logic is very simple, Nana. Abnormal loss and wastage is your inefficiency. Okay, if your competitor does not do any inefficiency, then you and him cannot actually do business. You having inefficiency, then accordingly your cost will get inflated, accordingly your selling price will be inflated. You will not be able to actually do business. Thereby, when it comes to abnormal loss and wastage, that will be totally removed when it comes to percentage calculation over here. Is that clear? However, this is the twist. Cost of major components delivered but not yet installed, like elevators and stuff like that, will be removed initially. When you are calculating this particular formula, when you're using this formula, it will be removed from both numerator and denominator. Numerator is cost incurred till date, denominator is total estimated cost. As well as from transaction price also it will be removed. Later, again it will be added back. Sir, what is this, sir? Why is it? See, the logic is very simple, because you did not do any value addition when it comes to, see, for example, understand, when you try to build big projects like, for example, gated communities and stuff like that, at the beginning itself they'll buy all these elevators, but then unless the entire structure is done and that elevator is ready, once you install it and then do all the other stuff like programming and stuff like that, then only the value addition you're doing. So as a contractor, what is the value addition that you have done? If you have just purchased elevators and kept it in the site, there is no value addition that you have done, na? You understand the point? Therefore, to the extent of cost of elevator that you have incurred, that I'll reimburse, that you can add. But upon that, you cannot enjoy any profit margin. That is the logic over here. You understand the point? Because what is the reason behind finding out percentage of progress? Say, for example, after putting this formula, if you get percentage of progress as 40%, what we will do is, we'll see total revenue and then we multiply with 40% and that much revenue will be recognized. You understand the point? So therefore, if you add the so-called, what is this elevator, then that will increase this 40% work completion to 50%. In reality, you did not do any work. You just purchased elevator and you kept it like that. And then you will be recognizing 50% of the total revenue, which is wrong, na? Because you did not do any value addition on elevator, na? You understand what I'm trying to say? Yes, that's the point over here. So, cost of major components delivered but not yet installed, example, elevators purchased and delivered but not installed in a building project, will be removed from both numerator and denominator and transaction price. Later it will be added. Sir, what do you mean by that, sir? I'll show you a solution here so that you'll get clarity. See here. Input based method, okay? Percentage of progress, cost incurred till date divided by total estimated cost into 100. This number will be given in the question. You got 20%, okay? Revenue to be recognized. Total transaction price without elevator. Got it? So you'll remove the elevator, you'll take total transaction price without elevator, you multiply with percentage of completion. So total is 35 lakhs into 20%, you got 7 lakhs. Then cost of the elevator will be added. Now the total revenue to be recognized is 22 lakhs. What it means is, in this, there is profit element. Why? Because you have worked something as a contractor and you deserve the profit. Are you able to understand? because you have done some value addition work. Whereas when it comes to elevator, you did not do anything. You have yet to install that and do all those programming, that this and everything. You need to sync it now with the building, all those things. You did not do anything. There is no value addition from your part. However, because you have incurred expenditure and it's a capital component, it's very costly. Therefore, I will reimburse the cost. So to that extent, it will be added back to the so-called 7 lakhs, and ultimately 22 lakhs will be recognized. Do you understand the point? See, there is a difference between treatment of abnormal loss for inefficiency as well as the elevator cost. Abnormal loss will be totally ignored. When it comes to elevator, it will be ignored initially and later the cost will be added back. That's what we have done over here. So I gave you that clarity over here. See here. Students doubt cleared, because many students have asked me this. Types of cost and treatment. Normal construction or service cost included in percentage of progress. Abnormal loss excluded completely. Major component like elevator, turbines, they are high value, distinct and delivered early in the project, excluded from percentage of progress, but after that cost of them will be added back. I hope this is clear. Right. Are we done with this? Yeah. Now, let's look at examples from your problem solving perspective. Output based method. PK Limited enters into a contract to construct a customized software system for a client over a period of 12 months. For total contract price of 20 lakhs. PK Limited determines that PO is satisfied over time, obviously, because it is customized software system, right? We know that over here, it fits into the third category. Now, and it chooses to use output method to measure progress based on the milestone achieved. Okay. That output method milestone completion is given. Design phase, it will take 4 months. Percentage of completion is 40%, which means out of the total transaction price or contract price, which is 20 lakhs, 40% will be recognized as revenue. Simple. After 9 months, another 35% development phase work is done. So 20 lakhs into 35%, that will be recognized. And after 12 months, 25% testing and development is done. 20 lakhs into 25% will be recognized. That's all. Very simple. You just see the percentage of, this is not cumulative percentage of completion, Anna. This is individual percentage of completion with respect to the respective works. Got it? Input based method. PK Limited enters into contract for construction of warehouse for customer. Contract price is 50 lakhs. Total estimated cost to complete is 45 lakhs. Cost incurred till date is 18 lakhs. PK Limited uses input method to measure progress. Very simple. Cost incurred is 18 lakhs divided by total cost is 45 lakhs into 100, 40%. So the revenue total transaction price is 50 lakhs. 50 lakhs into 40% will be recognized as revenue, which is 20 lakhs. That's all. Because this is a small example, I did not include all those elevator and all that stuff. I hope this is clear. Done? Everybody? There are certain special notes over here, Nana. Calculation of amount due from to the customer. It can be contract asset or liability depending upon that. See, because what happens, these are all big projects, Nana. So you calculate this input based method, output based method, and you know that this much revenue is recognized, and you expect that much of cash to be received from the customer. But usually it will not match now. Either customer will pay more or customer will pay less when compared to your revenue recognition, right? So in that case, you'll be having either contract asset or liability. For example, cumulative revenue recognized till date, say for example 40 lakhs according to your calculation based on input method or output method. Okay. Payments, cash payments received from the customer is, say for example 35 lakhs. Then you need to further received 5 lakhs, which is nothing but due from customer. So if it is due from customer, that much you need to receive. So obviously it becomes a contract asset. That's all. Or in simple words, debtor. Suppose you have done only 35 lakhs of work. In the sense, 35 lakhs of revenue is recognized in your books, but you received 40 lakhs from the customer. Then it is negative balance. 5 lakhs, you have received more from the customer. So whenever you receive more from the customer, always we see it as a liability, because if something goes sideways, you need to pay it back. Therefore, it will be seen as a contract liability or the income or revenue that you are yet to earn. Simple common sense. Nothing much to discuss over here. Clear? Right. Moving on to next one. Calculation of work in progress. Now, calculation of work in progress, what is the situation over here? Work in progress means capital work in progress is what we are talking about, right? Work in progress represents the cost of work done that hasn't been recognized as expense or when revenue is yet to be matched. Cost incurred till date less cumulative cost recognized in P&L till date, the balance will be WIP asset. For example, if 5 lakh is the cost incurred but only 4 lakh is allowed to be debited in P&L account, 1 lakh will be shown as WIP asset. Whatever that you incur, everything will not be allowed to be debited in P&L account. Please try to understand. It's not that important, just a point to note, that's all. Alright, so with this we are done with all the 5 steps revision. In a very quick time we have done it. So now we'll go for special cases. Let's look at the next case, Nana. Principal versus agent. All the 5 steps are done. The major part of the IND AS 115 is done. Hereafter, we'll be going with some special cases. Okay. In that, first we'll start with principal versus agent. Now look at this. Let's say there is an airline company. Okay. So first, the airline company name is, let's say it is PK Limited, and this PK Limited is a travel agency. Now what this PK Limited does is sells tickets on behalf of airlines and receives commission of rupees 500 per ticket sold. Selling price of the ticket is, say for example, 10,000. Now the point that you guys need to observe here is, who bears the risk of not selling tickets? Airline company. Who fixes the selling price of the ticket? Airline company. Everything is decided by airline company. The travel agency just receives commission for a ticket that is sold. There ends the matter, that's all. And that is flat 500 per ticket, which means here the kind of relationship that the airline company and the travel agency have got is airline company is principal and travel agency is agent. Simple, that's all. Entity does not bear inventory risk as well, nor has discretion in setting prices. Inventory risk means inventory of tickets I'm talking about, okay? Nor discretion in setting prices means, discretion means your choice. You cannot set ticket prices at your choice, na? You means I'm talking about travel agency, which is PK Limited. Whatever the selling price that is being set by the airline company, PK Limited has to just follow and sell at the same selling price. You got the point? All it will get is commission. So in this case, the relationship between the airline company and the PK Limited is a principal agent relationship. Got it? Now, in that case, obviously, airline company, what it will do? It will recognize the entire revenue of the ticket. And for that, commission will be recognized as an expenditure, as simple as that. When it comes to PK Limited, because PK Limited is agent in this scenario, its revenue will be only commission income, as simple as that. So it's a very simple scenario here. Now, this is interesting. See here. In this case, if you look at PK Limited, what is happening? PK Limited purchases tickets from airline company in bulk at reduced rates. You understand the point? Like for example, 1,000 tickets, 10,000 tickets, whatever the quantity as the case may be. First, PK Limited will buy it from the respective airline company, Indigo or whatever it is. And then he will sell at his discretionary prices. Whatever the price he feels like. You got the point? So buy specific number of tickets, so which means you have inventory risk. Suppose if tickets go unsold, in that case you need to bear the risk. Pays for those tickets even if not able to sell them. That's what we call inventory risk. Entity determines price at which the ticket will be sold to the customer, which means you have independence. This travel agency in this scenario has got independence. Thereby, in this case, the relationship between airline and the travel agency PK Limited is principal relationship. That's what we have written here. Now, in case of principal relationship, how to recognize the revenue? Very simple. See here. If your role is principal, then just recognize revenue on gross basis. That's all. As simple as that. Whatever the amount that you collect from the customer, that will be your revenue. Got it? Chalo, fantastic. Of course, the cost of purchase will be your cost. As simple as that. Because you have bought tickets now, that will be your cost. And whatever you are selling to the customer, that will be your revenue. As simple as that. Revenue minus cost is your profit. So that's what I've written here. I hope this is clear. So I will not be getting into all these details because already the concept has been explained. You can see the indicators that an entity is a principal. Primary responsibility will be there, inventory risk will be there, pricing discretion will be there. If all these qualities are there, then the entity is referred as a principal, which we have seen in this case. So thereby I'll not be covering this again because it's a revision session, Nana. We need to cover ASAP. I hope this is clear. Chalo, moving on. The next concept is non-refundable upfront fee. It's again another special case scenario. So what is this? Let's try to understand with this example. See here. Suppose customer joins gym and it charges joining fee, which is non-refundable. How much? 4,000. It's a kind of one-time fee. Okay. Plus membership fee is 12,000 for 12 months. All right. Total you have to pay 16,000. Now, we are talking about this 4,000. Now, the focus is on 4,000. Now, see here. Case 1. For this 4,000, whatever you have paid as a joining fee for the gym or one-time fee, as the case may be, whatever you call, gym kit is provided by the gym, which includes t-shirt, bag, bottle, and all those things. So from this, what you have to understand, this 4,000, whatever you have paid for that, are you getting any distinct service in return? Yes, I've got some distinct goods as well as some distinct service. So 4,000 is not just like that. For that, I'm getting something in return, which means because you're getting some sort of distinct service or good in return, this 4,000 will be treated as separate performance obligation. Got it? And because that separate performance obligation, in a way, transfer of control of these goods did happen on day one itself, which means PO for this particular 4,000 got satisfied on day one itself. Therefore, to that extent of 4,000, you can recognize the revenue on day one itself. Clear? What about 12,000? This is service is being provided over a period of time. Na? Therefore, transfer of control happens over a period of 12 months. Therefore, PO is satisfied over a period of 12 months. Therefore, revenue should be recognized over a period of 12 months. Simple, that's all. Now, coming on to case 2, here, the same 4,000 you have paid, but nothing is given to you for that 4,000. In that case, you will not treat it as a single PO. So that 4,000 will be mixed with 12,000 and entire 60,000 will be treated as a single PO for gym. That's all. So therefore 16,000 will be divided by 12 months. In that case, you will be getting 1333 per month. And in this case, your so-called transfer of control happens over a period of time for 12 months. And the PO is getting satisfied over a period of time for 12 months. And thereby, over a period of time for 12 months, revenue will be recognized. For 12 months, it is 16,000. So per month, it will be 1,333. So first month is done. This much of revenue will be recognized. Simple. That's all. Are we done? That's what I've written here. Clear? Chalo. Moving on to the next one. The next concept is sale with right of return. Let's look at this example. You'll be able to understand that. Now, the next concept is sales with right to return, Anna. Very simple. All these entries and the concept, everything, I'll try to explain you with the help of a simple example. Okay, see here. PK Limited sold 600 units of a product A to SK for 1200 each. Cost per unit is 900. 30 days is the return policy, which means before 30 days you can return. PK Limited expects 40 units to be returned. Now, what is the concept that we are discussing? Sales with right to return, which usually we do every day in Amazon and all the online, especially when we order clothes, right? Chalo, anyways. Now, in this case, the point is, even though you have sold 600 units, you have received money for 600 units, 600 into 1200, 7,20,000 you have received into your bank account. So, you'll debit the bank account. There is no doubt in that. But the entire 7,20,000 cannot be recognized as revenue. The reason is, you are already expecting that 40 has to be returned, which means to the extent of 40, you have to pay the refund. When you know that to the extent of 40, it will be returned and you need to make the refund, how can you recognize revenue to the extent of 600 units? So then, logically speaking, revenue has to be recognized to the extent of 600 minus 40, which is nothing but 560. Got it? So 560 into 1200, you'll recognize the revenue. And the balance 40 will be kept under something called refund liability, because you know that on the date of the sale itself, you know that 40 is expected to be returned, which means to the extent of 40, you need to refund. That's a liability on your part because you have an obligation to refund. So it's a refund liability. Got the point? This entry is very easy to understand. What students usually miss is this entry. Immediately, it should be followed by inventory or right to receive asset. See, when you create a refund liability, when you say that I have an obligation to repay the money back, the customers also have got an obligation to give you your asset back. Sorry, it's not an asset, inventory back, isn't it? You understand the point, right? So that 40 also needs to be returned. Na? So therefore, you have a right to receive the asset. Got it? In this case, I'm talking about inventory. Okay. So right to receive the asset, debit, how much? 36,000. Why 36,000? Because when I say right to receive, I need to debit that because it's an asset na inventory with its cost only. Now, what is the cost of the inventory? 900. So 900 into 40. So to the extent of 36,000 only, you can recognize the asset. Now you can ask me, sir, why are you recognizing the asset right now? Because the moment when the sale did happen, I'll be reducing the inventory stock na, because 600 units has left my godown and went out. To the extent of 600 units, I would have reduced the inventory. You understand the point? Now, because I'm expecting 40 units to be returned, to that extent, I have to increase. I have to make sure that that much of inventory will increase. That much of asset I need to recognize. You understand what I'm trying to say? So therefore, I'm recognizing the asset to that particular extent. And of course, to cost of sales. Because earlier you would have debited cost of sales. Now to set it off, you'll be creating cost of sales to the same extent. You got the point? Later, two things can happen. Nothing can be written. As you have expected, units are written. Now this is easy. As you have expected, units are written means what you will do? You will make the payment to the extent of 48,000 for which you have already created the liability. Once you make the payment of 48,000, which is to bank, automatically this liability needs to be cancelled out. Therefore, you will debit the liability. Job is done. Now, don't say that, sir, okay, sir, you have received 40 units. Now, to that extent, let's recognize the units or inventory because inventory also will increase by 40. No, that you have already done. So which means logically speaking, when you are putting this particular entry, only on paper your inventory has got increased by 40. In reality, you don't have that inventory increase. Later, once the return happens, physical stock will increase and then it will match with your paper entry or electronic entry as the case may be. Are you able to understand? So that's why I've written here to clarify that doubt only. Physical stock will anyway increase. But You will not again increase it in the paper by putting an accounting entry. Why? Because you have already done that. So when you are actually passing out this entry, in reality, physically inventory did not increase because inventory is still with the customer. But because you have recognized liability expecting 40 units to come, you need to recognize the asset increase, inventory increase to the same extent of that 40 units. That's what you have done over here. I hope this is clear. Yes? Okay. Moving on. If nothing is returned, then you will cancel the liability. Okay. And you will recognize the revenue. Simple. And for this, you will put a reverse entry. Because expecting return only, you have increased the inventory. Na? If nothing is written, what you will do? You will decrease the inventory. Therefore, to inventory and cost of sales will be debited as an expenditure. That's all. Here, why are we creating cost of sales? Because already you would have debited when the sales did happen to the extent of 600 units. You got the point. But you know that 40 will be coming back. To that extent, you are trying to set this off. That's all. I hope this is clear. Right. Another small point which you will come across when you are solving problems with respect to this particular thing is restocking fee. What do you mean by restocking fee? For example, if you look at this example, I'm just giving full refund. Full refund means 1200 is the selling price. Now, entire 1200 is being given as refund to the customer. Usually that will not happen because when customer opens the cloth, the garment, whatever it is, t-shirt or whatever it is, whatever the kind of dress it is, and tries to wear it down and then tries to return it back, then the packaging charges, all those costs will be there. Na? So to that extent, what the companies usually do is that it will not give you 100% refund. They'll not provide you 100% refund, like let's say 95%, 98% or something like that. In this case, the selling price is 1200. Let's say the restocking or repacking or shipping fee is 100 rupees. So they'll not be refunding you the entire selling price. They'll refund you only 1100. Which means what will be the changes in the entry that we have already passed? Very simple. To the extent of 100, your revenue will increase because to that extent, your refund liability has got reduced. Na? You know that for 40 units, you need to refund. Nana. Earlier, you will be doing full refund. Therefore, your refund liability is 40 into 1200. Now, you will not be doing full refund. Na? Therefore, your refund liability will be 40 into 1100. Simple. Now, where does this 100 go? Very simple. It will be added to the revenue. Because while doing the sale itself, you know that when the refund happens for the 40 units, I'll not be refunding the entire 1200. I'll be refunding only 1100, which means that balance 100 is revenue for me. So, therefore, you add that. So, in a way, this 40 into 100, which is 4000, has shifted from refund liability to revenue. That's all. When it comes to this entry, there will be no change. There will be no change because this entry is based on cost. This entry is based on cost. 40 into 900. 900 is cost per unit. So therefore, this entry will not change. Only this entry will change when there is restocking or repacking or shipping fee. I hope is this clear? Everybody? Right. Fantastic. Now, next concept is warranties, Nana. Very simple when it comes to warranty. All this stuff we'll try to understand from the examples here. Nana, when it comes to warranty, please try to understand that there are two types of warranty, okay? One is assurance type warranty, the other one is service type warranty. You need to remember these words, okay? If you can see here, assurance type warranty and service type warranty. Assurance type warranty means when you try to buy a car, say for example, Creta car you are buying, Hyundai Creta, whatever comes along with the car by default, we call it as assurance type warranty. Because it's a kind of assurance from the manufacturer na, that the Creta car will be good for at least 3 years. And then if you want, you can buy extended warranty for another 2 years by paying additional fees separately. That extended warranty, we call it as service type warranty. Am I clear? So let's take case here. In this case, you are buying laptop, okay, plus 6 months warranty. By default, it comes with the laptop, which is mandatory. So you're not paying anything separately for this warranty. Please try to understand. It comes with the product. Same in case of Creta, the first 3 years warranty. So thereby, you should be considering this entire thing, the warranty plus the laptop, the product, put together as single PO. Eventually, entire revenue will be attributable to the product. So which means, let's say this plus this, where warranty comes by default, we call this as assurance type warranty. Put together, it is 60,000. Entire 60,000 will be recognized as revenue on the day one itself. When the transfer of control of goods, that is laptop in this case, is transferred to the customer, transfer of control is done, PO is satisfied, revenue will be recognized, including the warranty as well. Got it? You will not be seeing this warranty as a separate PO because it's a assurance type warranty. It comes by default. You are not charging for it separately. Whereas, look at case B. Laptop and 6 months warranty, that is assurance type warranty. This is single PO that we have already discussed over here. So there is no denying the fact. But when it comes to 3 years extended warranty, if you are purchasing it specifically, because everybody won't do that, this should be considered as separate PO, which we call it as service type warranty. So then what you will do for both these things put together only, you have made the transaction price now. So therefore, the transaction price should be allocated to these two POs. Now the question is, in what ratio you will allocate? We have already studied that in step 4. Allocate the total transaction price in the ratio of SSPs. So find out the SSP, standalone selling price of laptop, and extended warranty. In that ratio, you just allocate. Once you have done with the allocation of total transaction price, which you have paid for both this to laptop as well as extended warranty, laptop ka transfer of control happened on day one itself. Therefore, day one itself revenue will be recognized. Whereas for extended warranty, it will happen over a period of time. Therefore, you need to recognize that revenue over a period of 3 years. Simple. That's all. Got it? Everybody? Right. So with this, we are done with warranty, Nana. Chalo. Look at the next concept, Nana. Bill and hold arrangement. Now, the moment you look at this, it's a very unique thing. Why? Because I'll tell you, once we go with the example, you'll understand the concept. Okay. Let's say PK Limited entity is there. He's selling air conditioning to SK, who is the customer. Sale, billing, payment, everything happened on day one itself. But only thing that is missing is physical delivery. The customer says, I'll not be taking physical delivery now. I'll take it after 4 months. That is the problem. That's where all the problem comes. If he would have taken delivery on day one, then everything is very simple. You would have recognized revenue on day one. But if he takes delivery after 4 months, now the biggest question is, does it mean that transfer of control is happening after 4 months? Which means, does it mean I have to recognize revenue only after 4 months once the delivery actually happens? That is the first question. The second question is, this 4 months, I have to keep that asset with me, na? So do I need to charge any custodial services for the customer? In that case, how that has to be recognized? Which means whatever customer pays, in that a portion should be going for custodial services, remaining portion should go for revenue. So this is the confusion. So generally, sorry. Right. Generally, PK Limited may charge for warehousing, in essence, custodial services. Total transaction price, let's say it is 90,000. Okay. Now, what you will do, obviously, when the total transaction price is 90,000 and this is being charged by the entity both for product, that is AC, as well as custodial services, what you will do? You will say that, yeah, there are two POs, so obviously you have to allocate the transaction price in the ratio of SSPs. So sale of AC, custodial services in the ratio of SSP. SSP of AC is 85,000, custodial service is 50,000. In this ratio, you try to allocate this 90,000. You get 76,500 and 13,500. Now the question is, 13,500, I know, because this custodial services is provided over a period of 4 months in this example. So over a period of 4 months only, I'll recognize this. There is no doubt in that. The problem is with respect to 76,500. What should I do? Should I recognize it on day one, or I should recognize it after 4 months? Because physical delivery did not happen. So which means transfer of control of the good did not happen. That is the biggest question. So that is where, when it comes to bill and hold arrangement, what you need to do is that you need to ask yourself certain questions. What is that? We are talking from entity's point of view. Now, this request to hold the delivery for 4 months or to deliver after 4 months is requested by whom? Is it a decision by PK Limited or SK Limited? Now, it should be at the request of the customer. That is first condition. And the second condition is, whatever the air conditioning specific unit which the customer has purchased, that should be marked and kept aside, and it should not be sold to anybody else. You understand what I'm trying to say? Look at the conditions over here. Customer requested the arrangement. It is not for seller's convenience. The product is identified separately and then ready for physical transfer, but it is kept separately and it is not sold to anybody else. See, generally when it comes to ACs, what is the same model, na sir? We'll sell it. When the customer comes after 4 months, on that day, similar kind of model, whatever the unit is there, the piece, that will be sold, means it will not work, Nana. You understand the point? That specific unit which the customer has purchased 4 months back, that should be kept like that only. You understand the point? So in that case, if these three conditions are satisfied, requested by the customer, and that specific unit is kept aside and it is not sold to anybody else, then even though physical delivery did not happen on day one, it will be deemed to be delivered. Deemed. We will imagine as if it has been delivered and we will recognize the revenue on day one. But the most important point is three conditions should be satisfied. So, customer requested the arrangement. The product has been identified separately and ready for transfer, and the entity cannot use or redirect the product for other customers. In that case, the control is deemed transferred, and thereby you will be recognizing the revenue before the physical delivery as well. That's it. Are we done? Chalo. Sale and repurchase arrangements, agreements, as the case may be. Sale and repurchase. This is not something new, Nana. This we have already seen in financial instruments. It's not something new. Once I start discussing this, you will automatically understand that this is not something new. We have already seen this in financial instruments chapter. Okay. Chalo, come to the example. Through the example, we'll try to understand. If you guys are ready, we'll start. All right, Nana. Now look at this example. There are two companies, PK Limited and SK Limited, two entities. Okay. Now, PK Limited on day one sold goods worth 25 lakh to SK Limited. There's nothing wrong in that. Once there's a transfer of control for the goods, immediately PO is satisfied. You'll recognize that as a revenue. Who will recognize PK Limited? Naturally, because it will get the revenue. However, there is a problem. After 1 year, PK Limited will purchase from SK the same goods which earlier it has purchased for 25 lakhs. Sorry, it has sold for 25 lakhs. Now it will again buy back for 30 lakhs. The same goods. Now why to eventually sell and why to buy again? You understand the point? Then this actually looks like a financing arrangement only. Now, if you apply substance over form logic, goods are just like a security for you, isn't it? Like mortgage. So which means you're just keeping this guy is just keeping the goods and giving you a finance of 25 lakhs, which after 1 year you are paying it with interest for 30 lakhs, and as a result you're getting your goods back. That's what is happening. Even though the name, the form that they are saying is that it is sales and purchase. There is a form. But if you look at the substance, it seems as if it is like a financing arrangement. Same concept we have seen in financial instruments as well. So therefore, this is just like a financing arrangement with goods as mortgage. Okay. IND AS 109 applies here because that's what we have already seen this in financial instruments. Your repurchase price is 30 lakhs, your sale price is 25 lakhs, which means initially you got 25 lakhs money, you gave goods as a mortgage. After 1 year, you paid 30 lakhs, that is with 5 lakhs interest. Are you able to understand? And then you got your goods back because there is no more mortgage left over. So repurchase price is greater than sale price. In that case, you should be treating that difference of 5 lakhs between the sale price and the repurchase price as interest or financing cost. Look at the entry. First, because this is a financing arrangement, when you look at the substance, IND AS 109 says you cannot recognize this as a revenue. IND AS 115 also says the same. So as a result, once PK Limited receives 25 lakhs for selling the goods to SK Limited, which already has an agreement that after 1 year he'll purchase it back, then normally what will be your entry? Bank account to revenue, presuming that the transfer of control has happened. Okay, PO is satisfied. But now you can't write to revenue. You should be writing to financial liability because it is like a loan only, na, what he has taken. So loan is a financial liability because you have got an obligation to pay back. So bank to financial liability 25 lakhs. Then because you have to pay back 30 lakhs, extra 5 lakhs you need to add as an interest. So interest to financial liability, to that extent your financial liability will be increased. Already it is 25 lakhs. You'll increase it to 30 lakhs by adding 5 lakhs again. Correct? And then you debit the financial liability to bank once you are paying it back. When you're purchasing means you'll pay back the money, na? So obviously to bank and financial liability will be debited. As simple as that. So if you look at this whole setup over here, is there anything new that we have learned when compared to what we have already done in IND AS 109? Nothing. Nothing. So whenever there is an agreement of sale and buyback, you need to understand this is the same concept, sale and buyback, which we have seen. Here it is with a different name, sale and repurchase agreements, which is nothing but sale and buyback. So when it is a sale and buyback and you're buying it at a higher price, then obviously it's a financing arrangement where you're paying what? Interest. As simple as that. So treat it what the IND AS 109 says. So IND AS 109 says treat it as a financial liability. Therefore, bank to financial liability, then interest to financial liability, then financial liability to bank. Simple. That's all. Once you make the payment. Easy peasy. Nothing is there. But this is interesting. But another example. This is interesting. Sir, what is this, sir? Here, the repurchase price is less than selling price. What is this? Repurchase price is less than selling price. Usually this happens. Here I've written goods, na? Here you see what I'm going to write. Now, are you able to understand the difference? If you are smart enough, you will be able to understand the difference straight away. Sir. Here you have written goods, sir. Okay, goods are like mortgage and it is a financing arrangement. Therefore, your repurchase price is greater than the sale price because you have to pay it back with interest. But here, in the place of goods, you have machine and your repurchase price is less than the selling price. Which means it is just like a lease. It is just like a rent. This Mokku fellow gave machine, and this Mokku fellow Nana has used the machine for 1 year, and as a result, machine ka value has got reduced. Therefore, he bought it back at a lesser price. Eventually, this guy received 25 and paid 22, which means in a way he received 3 lakhs and this guy has spent 3 lakhs, which means just like a lease arrangement. Substance is lease arrangement, although the form, the name that you're calling it as sale and purchase of a machine. Understand the point? So how can you identify that? Very simple. Just compare the repurchase price and selling price. If repurchase price is greater than selling price, it is interest. If repurchase price is less than selling price, it is like a rent or leasing agreement. So this is a lease agreement, substance over form logic. So SK used PK Limited goods. Here I should not be writing goods. Let me write machine. Be able to sync well. Okay. Used PK Limited machine for 1 year. So PK Limited charges rent from SK Limited. In essence, that is 3 lakhs. So in that case, it is like a deposit liability. You have to treat it that way. Got the point? I gave you the machine, na? It is worth so many lakhs. For 1 year, if I'm charging rent itself as 3 lakhs, then what will be the worth of the machine? You can do anything with the machine, na? So as a deposit, I'm charging money. So deposit liability, why it is treated as liability from the point of view of PK Limited? I'm getting deposit only as a security for the machine that I gave it to you, which is worth more, even though your rent that you're paying is only 3 lakhs. So if you do something wrong with the machine, I'll hold this liability. You understand the point? But tomorrow, once you give the machine in its perfect form, then I have to repay that back. Na? Therefore, it is called as a liability. But the purpose of liability is deposit, as a safety deposit for the machine that I'm parting with. You know, got it? So therefore, you're receiving 25 lakhs, but that is not revenue for you. And it is not financial liability. It's a liability, but it is deposit liability. So you have to be very specific with respect to liability. Okay, deposit liability. Then what will happen? This deposit liability has to be reduced because that guy is using the machine. That guy is using the machine. Financial liability will be increased because you have to repay that back with interest. Deposit liability will be reduced because that guy will be using the machine and therefore machine value reduces. Got the point? Therefore, reduce the deposit liability to the extent of rent. And finally, how much will be the deposit liability after reducing by 3 lakhs? Because credit is 25, debit is 3. So it has been reduced to 22. Then you have to repay back 22. That's all. So deposit liability debit 22 to repaying back, which is nothing but to bank 22. Simple. If you understand the essence, it's very easy, Nana. It's not at all complicated. This one is clear, these two. So only thing that you guys need to understand is that just compare the repurchase price with the sale price. If the repurchase price is greater than the sale price, it is interest. If repurchase price is less than the sale price, it is rent or lease. Simple. Are we done? Understood? I mean, very simple. Chalo, come here. This we'll see later. Let's look at this. See, Nana. Accounting in case of forward agreement and call option. Sir, what is this forward agreement? What is this call option? Okay. To understand that, come back here. Sale and repurchase agreements. Sometimes an entity sells goods but agrees or has an option to repurchase them later. That is there at the beginning itself. That's when you can find out that the substance of the transaction is different when compared to the form of the transaction or name of the transaction. Depending upon the terms, these can be treated as financing, that is the first case, leasing, that is the second case, or sale with return rights. Sir, what is that? Sir, that we will see later. Just wait. Types of arrangements, that is sale and repurchase agreements or arrangement, can be a forward agreement, can be a call option, can be a put option. When it will be regarded as a forward agreement, when it will be called a call option, when it will be called a put option. Very simple. Forward agreement means entity sells goods but promises to repurchase them at a fixed price. Here it is fixed price only, na? And this fixed price can be greater than the sale price or less than the sale price. Fixed price is nothing but repurchase price. So these both are forward agreements only. Both these are forward agreements. In the first case, it is a forward agreement, which is a financing agreement. In second case, it's a forward agreement, which is a lease arrangement. You understand the point? So entity sells goods. It has sold good. It has sold good, but promises to repurchase them later at a fixed price on a fixed date. Promises to repurchase at a fixed price. That's all. He is not mentioning that the price has to be high or low. It can be high, it can be low. If it is high, it will be a financing arrangement, forward agreement and financing arrangement. If it is low, it will be forward agreement and lease arrangement. Clear? So forward agreement can be financing or can be lease depending upon the fixed price, whatever that you have decided, whether it is greater than the sale price or less than the sale price. But in both the cases, forward agreement means what, Ray? Now itself you are fixing the future price. Did you fix the future price at the beginning itself? Yes. Did you fix the future price at the beginning itself? Yes. It's a forward agreement. Forward agreement can be taking a nature of financing arrangement or lease arrangement. That depends. That depends upon the fixed price, what you have already fixed, is greater than the sale price or less than the sale price. That's all. Is that clear? Is that clear? So both these example, what I've seen here is a forward agreement. In one case, it was a financing arrangement. In another case, it was a lease arrangement. I hope this is clear till here. Everybody, yes, just confirm me. Fantastic. Here, accounting in case of forward agreement. Forward agreement only focus. Repurchase price is greater than original selling price, then it will be a financing arrangement. Repurchase price is less than original selling price, then it will be a lease arrangement. So forward agreement can be financing, forward agreement can be lease. Simple, that's all. Is that clear? Now why I've written and a call option? Call option means right to buy. You are purchasing now after 1 year. You are purchasing now after 1 year. Call option means what? Right to buy. Right to buy. So PK Limited has got right to buy. PK Limited has got right to buy. And because it is in his control and already there is an understanding at the beginning itself that this is financing arrangement, therefore definitely he'll buy after 1 year. Therefore definitely he'll buy after 1 year. Because the right is with PK Limited and we are doing accounting from the perspective of PK Limited only. And he has got right to buy, so he'll definitely buy. And as a result, the accounting treatment will be same as forward agreement. That is nothing but what we have done here. So therefore, when I've written the heading here, forward agreement and call option, ultimately the accounting is same. Ultimately the accounting is same because the right is within PK Limited. So if repurchase price is greater than selling price, the buyer has effectively lent money. So it's a financing arrangement. If repurchase price is less than selling price, the buyer is essentially leasing. Who is the buyer? Who is the buyer? Who is the buyer? PK Limited in both the cases because he's the one who is buying after 1 year. That's why he's called as buyer. Clear? Right. So when it comes to sale and buyback or sale and repurchase agreements, it is referred as forward agreement if you have agreed to buy it at a fixed price. If you agree to buy back at a fixed price. But that fixed price can be greater than the sale price, then it will be a financing arrangement. Less than the sale price, then it will be a lease arrangement. Clear? But no matter what, it is forward agreement. And in case of call option also, the treatment is the same because you have the right to buy. Who the buyer? Who is the buyer in our example? PK Limited is the buyer because he buys after 1 year. And if he has got right to buy, he'll definitely buy because the point is the arrangement is financing. So definitely he will buy at a higher price. Got the point? Here also definitely he'll buy. So therefore the accounting remains the same. Whether it is call option because it will be the right of the PK Limited or forward agreement. In both the cases, the accounting, the entries are same. However, put option is a little bit different. Put option is a little bit different. Why? Because in case of put option, the right will be in the hands of SK Limited. Understand the point? Let's see how this is going to happen. If the customer, because customer is SK Limited in this case, if the customer holds the right to resell the goods to the entity, so we are talking from entity's point of view, then it will be referred as a put option because if the option is in the hands of the entity, it is call option. If the option is in the hands of the other party, in this case it is customer, then it will be referred as a put option. Then the treatment depends upon what the other party is likely to do, isn't it? Because it is not in my control. In this case, this is the accounting that we will do because whether it is forward agreement or call option, it is in my control and definitely I'll exercise. You understand the point? Whereas when it comes to put option, I don't know what the other guy will do. He will exercise only if it's beneficial for him. Correct? Right. So if it is likely to exercise, so you have to start expecting what the other party will do, which is customer in this case. In my example, it is SK Limited. If I am anticipating, that is, if I am means PK Limited is anticipating that SK Limited is likely to exercise the option, which means PK Limited has to buy. Then it can be a financing arrangement or it can be a lease arrangement as the case may be, financing or lease. Then in that case, the accounting will be same. So if I feel in case of a put option that is right of executing is in the hands of the other party, which is out of my control, that is PK Limited. If PK Limited is anticipating that SK Limited will exercise, then you have to look into the repurchase price. If it is greater than, it can be a financing arrangement. In that case, the accounting will be like this. If it is less than, then it will be like a lease arrangement. So the accounting will be same. That's what we have written here. However, SK Limited is not likely to exercise. He is not willing to sell it back, which means PK Limited cannot buy it back. If you cannot buy it back, then the whole thing falls away. It should be treated as a genuine sale. Therefore, account as sale with right to return. That's all. Recognize refund liability. You'll recognize that because once he returns, you have to pay the money back. Na? See, once you sell, PK Limited gets money, right? And put option is in the hands of the SK Limited. You don't know SK Limited will exercise the option or not. If he exercise, he'll give the goods back and I have to pay back the money. So therefore, it's a liability for me. So You understand that? So I'll receive money, so the debiting bank account, but then I have to recognize the refund liability. So once he returns the goods, then I have to pay the money back. Got the point? If he lapses the option, then only I get confirmation that he is not going to return the good. In that case, I can recognize that as a revenue. Therefore, it will be referred as sale with right of return. That's what I've written here in the heading. Sale with return right. So which means in forward agreement, in call option and put option where the other party is likely to exercise, the accounting is the same, which we have learned here. Again, I repeat, in forward agreement, in call option as well as in put option in which the other party is likely to exercise, the accounting is the same. Only in case of put option where the other party, that is in our case customer or SK Limited, is not likely to exercise the option, which means he will not return the goods, which means it should be treated as sale with right to return. Got it? And you will be recognizing a refund liability at the beginning when the sale eventually happens. So if the option lapses unexercised, customer does not exercise the repurchase or return right, the entity de-recognizes the liability and recognizes revenue. So revenue you should recognize after getting clarity that customer will not refund the goods. Customer will not return the goods. On that day when the option is lapsed in the hands of the customer, then only your sale is certain. Till that time there is uncertainty. Then what you will do? So what will be your initial entry? Bank account debit to refund liability. Then once the option gets lapsed and you are sure that now the sale has happened because the customer has no option to return, then you will cancel the liability because there is no more liability for you because you need not refund the money. Then you recognize the revenue. So refund liability debit to revenue. Clear? Are we done with this? It's a very beautiful concept. Okay. Out of all the special cases that we have seen so far, sale and repurchase agreements is interesting. Okay. Now we need to solve question number 66 and 67. If you guys are ready, we'll start. Come on, give me confirmation. Shall we go solving, Nana? Right. 66 and 67. Let's finish it off. Come to question number 66. Easy only. Once you know the concept, it's very easy. See here. An entity enters into a contract with a customer for sale of a tangible asset, okay, on 1st January for 1 million. Fine. The contract includes a call option, right to buy. Okay, that gives the entity the right to repurchase the asset for 1.1 million. Very simple. Call option, forward agreement, the treatment is the same. So repurchase price is greater than the sale price. So which means it's a financing arrangement. So what will be your entry? Initially you'll be selling for 1 million. So bank account debit to financing liability. Very good. Then interest or financing cost to financing liability to the extent of 10 lakhs or 0.1 million. So that your financial liability from 1 million reaches 1.1 million. And then what you'll do, financial liability debit 1.1 million to bank because you'll be buying back where you'll be paying money. So to bank, that's all. Simple financing arrangement. Okay. Here you have the answer. Amount received shall be recognized as liability, that is financial liability. Difference between sale price and repurchase price to be recognized as finance cost or interest. That's all. Very simple. Done and dusted. Coming on to question number 67. Once you look at the examples, once you are done with the examples, these are very easy, Nana. An entity enters into a contract with the customer for sale of tangible asset on 1st January for 10 lakhs. Okay. The contract includes a put option. You have to be careful. That gives the customer the right to sell the asset for 9 lakhs. Have to be careful. Okay, so the price is less. Repurchase price is less than the sale price. That's okay. On or before 31st December 20x1. The market price for such goods is expected to be 7,50,000. How would the entity account for this transaction? Very simple. You need to see whether that guy will exercise or not. If he exercises, because the repurchase price is less than the initial agreeable price, obviously it will be considered as a leasing arrangement, right? Then you'll have a deposit liability, bank account to deposit liability. Then deposit liability will be reduced to lease payment, and then deposit liability will be debited to bank. That's what your entry will be, right? Everybody, right? But in case if he lapses, then it will be sale with right to return. So initially you'll be recognizing that as a refund liability, and eventually what you'll have, that liability will be debited and revenue will be recognized once the option lapses. That's the usual concept that we have learned. Look at the answer here. In the above case where the entity has an obligation to buy back. Why entity has got an obligation? Because the put option is in the hands of the customer. So if SK Limited has got right to sell, the option is right to sell, then PK Limited has got obligation to buy. So obligation to buy back the goods up to certain date. The entity shall evaluate if the customer has significant economic incentive to return the goods, which means if he will exercise the option or not. The meaning of this sentence is, what do you mean by evaluating if the customer has got economic incentive to return the goods? Because customer will exercise the option only when he has an incentive to return the goods. The logic is very simple. If there is no economic incentive, why would you exercise the option? You'll exercise the option only when it benefits you. Option benefiting you is nothing but economic incentive for you. So evaluating whether your customer has got economic incentive or not is nothing but you are thinking whether the option is exercisable or not. If it is exercisable, then your treatment will be either financing arrangement or lease arrangement, as the case may be. In this case, it will be a lease arrangement. Okay, because the repurchase price is less. If he is not going to return, then it will be sales with right to return. You will recognize the revenue, debit the liability. Since the repurchase price is significantly higher than the market price, therefore, customer has significant economic incentive to return the goods. So in this case, he is going to return the goods. Why? Because customer returning means you will be paying money to the customer. How much you are paying money to the customer? 9 lakhs. Whereas in the market, the value is only 7,50,000. So therefore, customer will have a benefit of 1.5 lakhs. So therefore, definitely he will return. If he is return, then definitely you have to get it back. If you are going to get it back, in the sense you have to buy it back, then you are buying it back at 9 lakhs, which is less than 10 lakhs, at which you have sold initially. Therefore, it's a leasing arrangement. That entries you will pass, leasing arrangement entries. Therefore, company determines the control of the goods is not transferred till the put option exercises. Against payment of 10 lakhs, bank account debit, the customer only has got right to use the asset and put it back to the entity. Therefore, it will be accounted as a lease transaction. Got it? Difference between 10 lakhs and 9 lakhs will be recognized as lease rent, lease income. Get the point? So, at the end of the repurchase term, the customer does not exercise such right, then the control of goods will be passed to the customer. In that case, you can recognize the sale of goods. But anyway, that will not happen. So why did he give you this sentence? Doesn't make any sense. Because it was clearly given in the question that he has got economic incentive. So therefore, customer will exercise for sure. Where is the question of customer not exercising? Because customer has the option to sell it at 9 lakhs when the value in the external market is only 7,50,000. So customer will exercise the option for sure. Therefore, it is a lease arrangement for sure. That's all. Lease arrangement regarding entries only you will pass. There ends the matter. This sentence itself is irrelevant. See, that's what your ICA answer sometimes it will be like this. We can't do anything. See? Is that clear? Everybody? Hello. Fantastic. Let's continue. We have 6 and 6 and 67 is also. Chalo, let's move on. Come to the next one, Nana. Service concession arrangements. Important, Nana. Mark it as important. Very good concept. Right, Nana. Let's continue. Now, mark this as important because there's a lot of confusion going on with respect to understanding the service concession arrangement. Okay. As I told you, there are certain rare case scenarios in the subject where even faculties themselves they don't get the clarity, unfortunately, because of the depth and stuff. There are a lot of other things going on. So this is one such area. Okay, I'll tell you when the time comes where the issue is there. Therefore, I want you guys to focus. Okay, guys are ready? Nana. All right. Now, okay, before we start with this, first of all, let's go with this example. Okay, before that, let's start with this one. Then we'll go for the example. See, first of all, let's try to understand what do you mean by this service concession arrangement? So basically, it is contract between two people. Who are they? One is the operator, and the other one is grantor. So basically, operator is the company or the entity. Grantor is the customer. Okay. Why he is called as a grantor? Typically, it will be the government because he grants the right. Sometimes he grants the revenue. Now, this operator constructs or upgrades an infrastructure that will be used to provide a public service on behalf of the grantor. Basically, grantor is the customer. Okay, right. The name used is as grantor because the logic is that he grants the license. That's the reason. Collect the toll and stuff like that. Anyways, the examples are national highways, bridges, tunnels, airports, public transport, or anything that is of public interest, public use. Okay. So typically, the best example you can understand is highways, national highways. Okay, where the entity or the operator constructs the highway and then the grantor typically grants the license, collect the toll. Got it? Sometimes they will also give money as well, especially when it comes to state highways. Okay, state highways, generally what happens is that they'll not, state governments will not be interested to collect toll. Probably what they'll do is that they'll just pay the payment right away. Okay, and the road will be free for the public to use, because that money is already indirectly collected through your road tax. When you buy a car or a bike, all the money that you pay in road tax na, is in lakhs, eventually goes to the state government, and the state government has to logically use that to build the state highways, which should be eventually free of cost. And the national highways are constructed by the National Highway Authority of India, where anybody who wants to reach the destination at a higher pace, at the higher speed, and wants to move fast, you can use the national highways and eventually pay the toll and then move on. So it should be like a choice. But unfortunately, in our country, what happens is that because anyway, national highway is constructing roads, and people are ready to pay the toll, and they don't question. Most of the state governments, they are not spending money on state highways. Once the national highway comes into picture, they are just diverting that money for all the freebies and toll. Okay, typically that's what is happening in our country. Anyways, having said that, now see here. This basic idea you've understood. What do you mean by service concession arrangements? It's between a company, an entity, okay, who is the operator, and the other guy is the government, who is basically a grantor. Clear? Right. And it involves, yeah, construction of anything that is basically used by the public. Okay. The operator builds and operates the infrastructure. It can be highways, bridges, tunnels, or airports for a specified time, and in return receives either a fixed payment from the government in case of state highways, or right to charge the public, that is toll collection, in case of national highway. Usually that's how it happens. There is an important point that you have to note here. That is the reason I've highlighted this. The infrastructure under such arrangements is not recognized as PPE by the operator. Very, very, very important. Because you don't have the right over the asset. Your job is to just construct it and hand it over to the grantor, that is the government. Because since it doesn't control the asset, the government does, the grantor does. Therefore, you cannot recognize that as an asset. Keep that in mind. Instead, the operator recognizes it either as a financial asset or intangible asset. Sir, what is this, sir? You will understand. We're going to learn this only. Right now, you will not understand this. Keep it as a question mark in your mind. No worries. Now we're going to understand that. Okay. Right. I gave an example over here. An entity builds highway for National Highway Authority of India and agrees to operate it for 15 years. So it means you need to maintain it as well. During that period, the company can either get a fixed payment from the government or right to collect tolls. Mostly it will be right to collect tolls. Okay. Chalo. Accounting treatment differs in each case. That we're going to see right now. So first we will see fixed payment scenario. That's what we have seen. Na? Financial asset and intangible asset. Financial asset in case of fixed payment. Intangible asset in case of right to collect tolls. Financial asset in case of fixed payment. Intangible asset in case of right to collect tolls. That we will be seeing now. Okay, chalo. Let's start with the first example. I want you guys to focus 100% over here. So this will be a little bit, will sting you a bit. Okay. I want you guys to focus. Ready? Okay. Fantastic. Now, okay, Nana. So we have two parties. We already know. One is the entity. The other one is the government. Entity is referred as operator or contractor. Government is referred as a grantor. This we already know. Okay. Now in this example, let us take construction of national highway. Obviously, right? That's the easiest example to understand. Now in this example, let's say construction period is for 3 years. So 3 years you'll construct the road. Fine. Total expenses estimated to be incurred is 200 crores. Fine. For a period of 3 years, obviously, because you're going to finish off the construction in 3 years. Fair value of the construction services is 220 crores. Why do we need fair value? Because IND AS 115 specifically says once you construct something, you have to recognize that at a fair value, not at the cost that you have incurred. But the point that we will see now. That's why fair value information is also important. Revenue related to the services during operation time is 60 crores, and that will be for 7 years period, and that will be paid by the government. Financial revenue, that is nothing but interest for late payment, because it is government or the grantor. Never you will get your money on time, so therefore always they will delay. So once they delay, they'll also have to pay you interest payment. Okay, so therefore that is also there. Okay, so total cash flow generated by the government is 300 crore, which means it has to be paid to the entity eventually after 10 years. 3 years for construction, 7 years for maintenance. Clear? Which means you will be operating. So this total 10 years will be divided into two phases. Phase 1 is construction phase, 3 years. Phase 2 is operation phase, 7 years. Is this clear? Yeah, this entire 10 years is divided into two phases. This is construction phase, this is operating phase. Clear? Right, fantastic. Now, we need to always focus on accounting aspect as per 115 in the books of the entity. have nothing to do with the government or the grantor. So who is important for us? Operator, constructor, contractor, or the entity, whichever name you want to call, you can call. Usually we'll call him as operator. Okay. Now let's look at the books of the operator. In this case, it is PK Limited. Obviously, that's the example that I've taken. Right now, see here. I told you that it has been divided into two phases. The entire period of 10 years. First 3 years construction phase, operation phases. Next 7 years. All right. Are we done with this? Okay. Now concentrate carefully. Here, because you are getting a fixed payment from the government, that is this one, you'll not get the payment immediately, but you know that you'll get the payment for sure. So which means you have a right to collect, money. The right to collect money satisfies, or right to receive money satisfies the definition of financial asset. Therefore, recognize financial asset. Two, for what you are getting money, because you have constructed a road, and that is a service that you have provided, and the transfer of service did happen, and as a result you have to recognize your revenue, and that revenue is nothing but 220 crore, and that revenue, construction revenue, has to be recognized at fair value. Clear? Fantastic. Next, of course, you have incurred cost, so therefore debit the expenditure, and when you have incurred the expenditure, obviously money will go out from the bank, therefore to bank. So there are two entries. One is recognition of revenue, the other one is expenditure recognition. Revenue recognition, expenditure recognition. Two things only, Nana. Revenue recognition means usually what we'll do, bank account debit to revenue. That's what we will do. But here we can't do that because we are about to receive money from the government in future. Right now we are not getting anything. Therefore, in the place of bank, you're writing financial asset, as simple as that. Right to receive money, right to receive cash, as simple as that. To revenue, which is should be recognized at fair value. And then for expenditure, you will be incurring another entry. That's simple only, na? Expenditure to bank. That's all. Construction cost to bank, as simple as that. This will happen in first 3 years. This is not yearly entries. Please try to understand. That is the reason I've specifically put a flower bracket over here and I've written 3 years. Got it? Don't arrive at a conclusion that these entries belong to a particular year. No. These entries are for all the 3 years put together. For all the 3 years put together. Clear? During construction phase. So these entries relate to construction phase in totality. Clear? Fantastic. After that, coming on to operation phase for the next 7 years, what will happen? Obviously, you have to get further revenue of 60 crores because that's what government has guaranteed for you, that I'll be paying you this much. So recognize that as well. Okay. So that is revenue. Again, you're not getting money, so therefore it will be a financial asset. You're not getting money. If you've got money already, then bank account will be debited. You're about to get money in future, therefore right to receive money. Therefore, we'll call it as a financial asset. Financial asset to revenue, and you'll get it for sure. That's why it is referred as financial asset. Then because you are getting the money late, this money also you did not get as of now. This money also you did not get as of now. So on everything you have to put the interest as well. That will also be given in the question. So therefore interest should increase your financial asset, the amount that you need to receive. Therefore again debit financial asset to the extent of interest and recognize interest income. It's income only for you. Government has to pay to you. We are doing in operators books, PK Limited's books. So obviously it's an interest income. Who has to pay interest to whom? Government or grantor has to pay interest to the entity. That entry is also there. And here also please try to understand this revenue recognition will happen over a period of 7 years, and that interest income is recognized over a period of 10 years. And finally, after 10 years, you'll get the payment from the government. Once you get the payment, obviously debit the bank account, and whatever the asset that you have created, where right to receive the money, that asset has to be cancelled out because you have got money. This is the entire journey. Now, there might be a little bit of doubt in your mind, but let me tell you, don't get confused. Just understand the flow. Total, there are 10 years, but here the concept is the government is going to pay the money after 10 years. First point. Till that time, you have a right to receive money because government has guaranteed giving you money. There's no question of bad debt over here because it's government. So therefore, you'll recognize financial asset. So during the construction phase, you have constructed by spending 200 CR. So once you have spent 200 CR, for that, what is the entry? Very simple, expenditure. So construction cost to bank 200 CR, done and dusted. Now the fair value of that 200 CR is 220 CR. Okay, and it should be seen as a separate performance obligation because you have already done the job. You have done the construction of road and you have transferred it. You understand the point? So therefore that job is done. So to that extent, you have to recognize the revenue. Got it? Now the revenue recognition will be what, Nana? Eventually, to revenue, obviously, at the fair value of the construction, which is 20 CR. And if you got the money, you'll be debiting the bank account, but you have not got the money. Therefore, right to receive the money, financial asset. Now you go to the operating phase, that is 3 years is done and dusted. Go to the operating phase. Now in operating phase, first thing is you have to receive further 60 crore to recognize that revenue. And because you are not getting the money, debit the financial asset. So financial asset to revenue, 60 CR. And after that, because the money is getting delayed right from the beginning, for that there will be an interest, and that is an interest income that will also increase your financial asset. So financial asset debit to interest income. In this case, it is 20 CR. Now you know that in totality, 220 plus 60, 280 plus interest 20, totally 300 you need to receive. Financial asset is showing 300. And now you'll be getting that 300 CR from the government. So therefore bank account debit because you've got the money. And now the financial asset is no more required because you've already got the money. Therefore to financial asset, it will be cancelled out and done and dusted. This is the entire flow. Yeah. Right. This is rather simple. So this should not be confusing for you when there is a fixed payment given by the government. So that's what I'm telling you. Receives fixed payment from the government. In that case, you will create a financial asset. So these two are connected. Getting fixed payments from the government, and it will be recognized as a financial asset at that particular point of time because you have got a commitment from the government now that you will be receiving money, right to receive money. Got it? That's a financial asset. Now, this is tad bit easy only. See here. If the entity has right to receive fixed amount of cash from government, in this case, the operator's right is contractually enforceable cash flows from the grantor, which is treated as financial asset as per IND AS 109. Here, the operator recognizes finance income over period because the payment is getting delayed. During construction phase, record revenue for construction services at fair value. So therefore, financial asset to revenue. How much? 220 CR. That is the fair value in our example. Then you have incurred cost. For that, you need to record construction cost to bank, which is 200 CR in our example. Clear? Next. During operation phase, record interest, that is unwinding of discount on financial asset. So you need to record interest, means that will increase your financial asset, obviously. So financial asset debit to interest income. Then record revenue for operation services as well, because you're going to maintain the road for another 7 years. For that also government has to pay you money, which is 60 crores in our example. That will also increase your right to receive money, right? So therefore financial asset debit to revenue. That is also part and parcel of revenue only because you're giving service. Earlier you have done construction service. Now you are done, now you are doing maintenance service. Earlier you have done construction service. For that you have to receive 220 CR. Now you're doing maintenance service. For that you need to receive 60 CR. And logically speaking, both these two put together for both different services, different POs, you need to ultimately get 280 CR. But you are getting it delayed. Therefore, interest also is added to the extent of 20 CR. Totally, you got to receive 300 CR for two different phases: construction phase, operation phase, for two different services: construction service and maintenance service. Both are not same. Please try to understand. Clear? And finally, record cash received, bank account to financial asset. So the operator is acting like a lender. That is a logic over here. Lender, building an asset and recovering the investment via fixed payments plus interest from the government. So the point, just like a lender. Clear? Right, fantastic. Now, are we done with this? Now, let's move on to another example. This is where things get interesting, so I want you guys to focus. Till here it's clear. Okay, chalo. Now this example, I want you guys to focus. This is an example where government will not be giving you fixed payment. Instead, it will be giving you a right to collect toll for a period of time, 7 years or 10 years or 15 years, as the case may be. So in this case, how are we going to do accounting? Now this is very interesting, so I want you guys to focus. Ready? Okay, now see here. In this case, it's the same example only, okay? Government is the grantor and PK Limited is the construction company, which you can obviously refer as operator or contractor. And it's the same construction of name. And data is also same. Construction period 3 years. Total expenditure estimated to be incurred is 200 CR. Fair value of the construction services is 20 CR. That entire construction phase will be for 3 years. And however, here there is no fixed payment from the government, that is 300 crores. What the government is saying, 300 crores worth money you can collect via toll from the users who are using the highway. And that will be allowed to be collected for a period of 7 years. After that, you will mostly what will happen, you will hand over the entire property to the government. That's why this is not your property. Therefore, we will not record it as PP. That in mind. That I've already given you clarity. Clear? Here, look at the interesting part. Government will not pay, but will give construction company right to operate toll for 7 years. Now, right to operate toll for 7 years is nothing but an intangible right. So you have to recognize that as an intangible asset. So therefore, treat it as intangible asset instead of financial asset, obviously. Financial asset means right to receive money. Here, that's not the case. You have a right to right to collect toll. and that's kind of a license. Therefore, it's an intangible asset. Clear? Now you'll have legal documents and all that stuff, obviously. So it satisfies the definition of intangible asset. It is identifiable, and you also have a right. Okay. Now let's see how the entries will work when it comes to books of what? PK Limited. First 3 years during construction phase, what happens is that you have to recognize your revenue. In the last case, you are done and dusted with your construction services. So therefore, one service is done. Once it is done, you have to recognize revenue as per IND AS 115. In last case, you are not getting money, but you have a right to receive money. Therefore, you used to debit financial asset. Now, in this case, you have to recognize your revenue, but you are not getting consideration in the form of monetary compensation. Instead, you are getting non-cash consideration. This is where many people forget to understand the depth of the concept over here. Are you able to understand? So people, sir, to revenue you have written, sir, you're recognizing revenue. On behalf of the revenue, you should get something, na? Then only we call it as revenue means what? Sales. Sales means what? You sold something, which means you should have received money. That's obvious. Which means consideration should be there. In the first case scenario, when there is a fixed payment on behalf of the government, do we have consideration? Yes. Government promised to pay you 300 crores. Only thing is that it will take time to pay you. So therefore, I know that in future he's going to pay me money. Therefore, I'm recognizing that as a financial asset. So this is your consideration. So it's clear. There is no confusion. Whereas in this case, where is the consideration, Bapre? The consideration is nothing but the non-cash consideration kind of have asset in the form of consideration. So therefore, recognize intangible asset to revenue. Obviously, revenue. Construction should be recognized at fair value. That will be your revenue. Clear? Construction cost entry obviously will come. Construction cost to bank. There is no difference in that. This is what happens during the construction phase. Fantastic. Now remember, this is one PO where construction services is done and dusted. Done and dusted. Now come to operation phase. Here, maintenance services is what you are providing. At the same time, you are collecting the toll. Okay. So therefore, what you will do, first of all, you already have an asset. Asset is nothing but intangible asset means what? Why it is valued at 220 CR? Because you get that much of benefits in the future because of that intangible asset. So therefore, asset always has to be depreciated. Because it is intangible asset, depreciation will be referred as amortization. Therefore, amortize it based on straight line method. That's all. So now you are using the right which was created earlier. Right means right to collect toll. So therefore, you have to amortize that. So do it for next 7 years. That is the entry over here. In other words, depreciation of the asset, Nana. That's all. Simple. Okay. At the same time, you are collecting toll, which is nothing but toll revenue, toll revenue, toll revenue, and therefore you are getting money. Therefore, debit the bank account. Now the point is, people tend to get confused between these two revenues. Look at one doubt from the student. Do not get confused that revenue is booked twice. That was one doubt from the student. Sir, are we booking revenue twice here? No. That's why I've written, do not get confused that the revenue is booked twice. It is not booked twice over here. Okay. Another student doubt is, this student in the chat box, he was trying to clarify the doubt of student 1. He was saying that no. Revenue is not booked twice. If you observe, revenue booked for receiving intangible asset, that is fair value of consideration, is getting reversed later through amortization here. Whatever you booked here, 220 CR, is getting reversed now, because as you can see here, 220 CR is created, here it is getting debited. Sorry, ITA is created, ITA is getting created over here, it's getting reversed. So eventually this is your actual revenue, was the answer of another student. And honestly speaking, there are certain videos that was shared by some of my students, and I've gone through certain faculties as well. Sorry to say, they were also going with the same logic. But in reality, is it true? That is the correct way of interpretation of what is happening over here, the form of two revenues that you see here? The answer is not. It's different. So for that, I need to dig deeper. So therefore, I want you guys to stay with me. This will take a little bit of time, because otherwise you will never understand this. You have to by heart. And you know, both of us know that neither I nor you like by hearting. So let's go through the logic. Now, to understand this, only the second case where government gives you right to collect toll. Okay. Step by step we'll go. So I want you guys to focus. Okay. First of all, revenue is being recognized twice. The answer is no. Revenue is not getting recognized twice. Clear? How, sir? We'll see. See, you are actually have to write along with me. That's the reason I'm also writing over here. Got it? Write along with me. You're recognizing revenue for two different services. This is what I'm trying to explain right from the and different. All right, Nana. Two different customers and two different times. Are you able to understand what I'm trying to tell you? Sir, sir, you are two different customers. What, sir? Nonsense you are talking. One by one, I'll come. First, what did I say? Two different services. Construction service. Two different customers. Government customer. Government is the customer. Two different times. First 3 years. All right, Nana. This one is clear. Look at the other example. Now, numbers and all those things we'll see different, okay? Right? That we'll see different. Other one is, okay. Maintenance service. Customer is what? Toll users. Not right, toll. Road user. Next to 7 years. This clarity is there for you. If you can get clarity over here, rest of my explanation will be very easy. Clear? So two different services, two different customers, two different timelines. Not get confused over here. Question of two revenues. It's not the same revenue. That's what you need to understand. The totality, you have to see them from different perspectives. Construction phase is different. Operating phases. Clear? ये तो clear है. Now, let's try AS 115. Now tell me one thing. IND AS 115 talks about revenue recognition. When you will recognize revenue? When who is satisfied. Any doubts in this? Clear? When PO is satisfied? When transfer of control. ये तो clear है. This is Holy Trinity. I've told you so many times. Let's start with first PO. Because I told you there are two PO over here. What is first PO? First performance obligation. Construction service. Who is the customer in this case for construction service? Government. You can also refer him as grantor. Correct? So when this PO is satisfied, because only if it is satisfied you can recognize revenue, na? Correct? Over time, not at a point of time. Okay, what is the consideration in this case? Consideration. For construction service, what is the consideration? Tangible asset. Very good. Till here it's clear. Any confusion? No. Very easy to understand. So here some people are having doubt. Please try to understand. Yes, sir. Clarification. Are you guys writing along with me? Remember, IND AS 115 does not say revenue is recognized only when cash is received. We discussed this point so far? No. There is no rule in Ind AS 115 that you have to recognize revenue only when cash is received. Non-cash consideration is accepted. In fact, we have gone through concept with a heading called non-cash consideration. How can you forget that? So consideration always need not be cash. Okay. So there is no link between revenue recognition and getting a cash. What does Ind AS say? Revenue recognition will happen when PO is satisfied. When will PO be satisfied? When transfer of control happens. Transfer of control of what? Goods or services. I'll write here of goods or services. This is the concept that we have learned. If it is non-cash consideration means we'll measure it at fair value. As simple as that. That's what we have done. Therefore, ये तो clear है. Therefore, during construction or during construction phase, okay, you will recognize revenue because this is a different PO, performance obligation, and the transfer of control when it happens, obviously, to revenue at fair value, which is nothing but 220 CR. And what you'll be debiting, it's a non-cash consideration in the form of intangible asset. So intangible asset debit, in our example, it is 220 CR. So what is the meaning of this? What is meaning of this entry? I'm trying to open banana, put in mouth, in the sense, it's a Telugu saying where we try to, explain things in a very, very, very simpler way, simpler fashion. I don't know whether people can understand that or not who are watching in other languages, but anyways, right now the point is this actually means I have completed, okay, construction services worth 220 crore for the government because the customer is government, na? And in exchange, what did I get? I have earned ITA, non-cash consideration, which is intangible asset. That is kind of economic, right? So the revenue is final and it is complete. It is not provisional. That's all. Recognized, done and dusted. Because my job is done. Are you able to understand? The moment you are done with your construction, then the consideration is in the form of intangible asset. So you are recognizing intangible asset means this PO is satisfied already and you have got it. Clear? Okay. Now, so ये तो clear है? First PO. Let's go to second PO. Now tell me, what is second PO? You people tell me now. Very good. Operating the road. Or correct? We'll go in the same flow. So first PO is construction service. Now, who is the customer in this case? Will tell me. Public. You can also call them as road users, not the government. Please try to understand this. Okay. What service are you providing? Access roads or highway. Okay. Or you can also call them as roads. Are you able to get it now? Should be very clear for you, right? When PO is satisfied, that is also important question. Because only when PO is satisfied, we can recognize the revenue. Right? At the point of usage. Okay. What is point of usage, sir? Each vehicle passage. Once the vehicle passage is done, respective PO is satisfied. Clear? What is consideration in this case? For each vehicle passage, when the PO is satisfied, okay, you will be recognizing your revenue, and that revenue is nothing but cash toll collected. Now you are not collecting cash, so therefore I can simply call it as toll collected. So therefore what you will do, you will pass the entry for toll collection, which is cash or bank account debit to toll revenue, because here you are getting revenue for the operating services, right? How much is that? 300 CR. To that extent you can collect. So what is the meaning of this entry? The meaning of this is I've completed construction services worth 220 CR for the government, and in exchange I've received the non-cash consideration, which is intangible asset. Here what is the situation? I am now providing road stage services and users are nothing but my customers paying me for that service. Simple. And that whatever they are paying me is considered as revenue. This has got nothing to do with construction. Please try to understand. This revenue has nothing to do with construction. Clear? Now the next question is, then why do we amortize the intangible asset? Very simple, matching principle. Na? This is not revenue reversal. That is where the problem comes. I'll write that question also. Then why do we amortize, okay, intangible asset? Answer, matching principle. Forget all these basics of accounting. This is not revenue reversal, which many people are understanding the wrong way. This is not revenue reversal. Clear? Right? It's just matching principle. Intangible asset is consumed as the road is used. That's all. Each year, part of the right is exhausted. Therefore, you are trying to amortize it. That's all. So I'll write that as well. Why amortization? See, Nana, why do you depreciate your asset? Because your asset is getting used. So each year, the value of the asset goes down. Therefore, you are representing that in the form of depreciation. Simple. Amortization also is for intangible asset is the same. Na? Each year you're using the asset, the value of the right to collect keeps on going down. Therefore, to that extent, asset value has to be reduced. Na? Simple logic, na? Simple logic. Get it? The intangible asset is consumed as the road is used. Simple. So each year that passes by, what happens? The right to collect toll or intangible asset value is getting reduced. So now this is what is happening. That has to be accounted, na? And that is what you are accounting it by way of amortization of intangible asset. Simple. So therefore, what will be the entry? Amortization expense to intangible asset. I'm consuming my right to charge users as I operate the road. As simple as that. Therefore, this is not like reversing your construction revenue. It recognizes the cost of using the right. That's all. Am I clear? Right. I hope this is. That is the reason. Don't arrive at a conclusion that you're recognizing revenue. The revenue is booked twice, or you're reversing the initially booked construction revenue. No, both are two different POs. Okay. I'll put an into over here. I'll put an into over here. Wrong. Wrong. So we took a lot of time to explain you the whole thing. I hope this is clear. And you guys have written along with me. You'll not get clarity anywhere in the ICA book. All these things will not be there. Please try to understand. Okay. People tend to get confused. This is the real clarity of what's happening. What? Clear? Done, understood? Right. So with this, we'll wind up the session right now. In the next session, I think we are done with the concepts. One problem, I think so. Yeah, 75 problem is, okay. That problem we'll try to finish. Okay, that we'll do it in the next session. I want you guys to revise this and come. Revise this concept, and then I gave you the logics over here. Na? This logic also try to revise. Clear? Right. Is license of intellectual property. Okay. So here we have first a basic idea. Then after that, you have right to access intellectual property. We have an example for that. Then right to use intellectual property. We have an example over here. Then we'll do two sums, in which one question is really good. Chalo. Let's start learning this concept. Chalo, Nana, first we'll start with first example so that we'll be able to understand this. But before that, just a basic idea. What do you mean by intellectual property? So it's simply you're getting license. Okay, you're getting license to use something. For example, it can be software, it can be technology, it can be media or entertainment content, movies, music, and all that. Franchisee, patents, trademarks, copyrights. So basically, you are getting a right to use them. As simple as that. That's what we call license, and that represents licenses generally will be taken for intellectual properties. Now, The only thing that you have to understand from accounting point of view is the license can be of two types, either right to access or right to use. Now, when it comes to right to access intellectual property, I have written here over time. Right to use intellectual property, I have written here point in time. I was indirectly talking about revenue recognition. So when the license is in the form of right to access, the license of intellectual property, then you will recognize revenue over time. When the license of right to use the intellectual property is the is a right to use, then in that case your revenue has to be recognized at a point of time. So this is a final answer actually, but you will not understand anything right now. So therefore what we are going to do is that we're going to go through examples. Okay, let's start with the first example over here, case 1. Now what's happening? There is a music production company ABC. Okay, yeah, it grants license to streaming platform, okay, XYZ company to use its music library for 2 years starting from 1/4/X1. Now, what you need to understand here is that whatever that is there in the music library as of now, plus in the next 2 years, whatever that is going to get uploaded newly, plus any other changes, everything can be enjoyed by ABC. That's the point. Okay. Sorry, everything can be enjoyed by XYZ because ABC is the company that actually is granting license to what? XYZ company. Got it? So, ABC company regularly updates its music library by adding songs throughout 2 years. So, this is where we use the term right to access. So, this license provides access to dynamic content. Focus on the word dynamic. Dynamic means what? Exactly opposite to static. Static means when I provide you license at that particular point of time, let's say I've got 100 songs. So you have license to use those 100 songs. That's all. Sorry. Are you able to get me? That's all. Only those 100 songs you can use. That we call it as static. Dynamic means as of today, there are 100 songs. Tomorrow it can become 120, 130, 140. So whatever the new things that I'm going to upload it, that also you can enjoy. Therefore, the kind of license that I'm giving you is a dynamic license. So the content, and that changes over time. The content also changes over time. Probably new content will keep on getting uploaded. Maybe some of the old content will be removed as well. Either way, it will happen. Ultimately, change will happen. Now, this XYZ company who has purchased the license benefits from updates during the license period, obviously. ABC company has ongoing obligation to maintain and update for the 2 years for which you have actually sold your license. Okay, so therefore, this is a perfect example for right to access intellectual property over time, because the service that is being provided by ABC company to XYZ company is gonna be over a period of time. I've gave you 2 years license now, and the content that I've gave you is gonna be dynamic. So therefore, I have to keep on providing you the new content. Are you able to understand? Which means I have to keep on providing you the service over a period of time. So therefore, the transfer of control of services will happen over a period of time of 2 years. Therefore, PO will be satisfied over a period of time. Therefore, revenue has to be recognized over a period of time. Now, in this situation, we call this as right to access because you have right to access all the changes that's going to happen in next 2 years. So therefore, in this case, revenue will be recognized over time because the service keeps on changing, the service keeps on getting updated, and therefore the transfer of control over service happens over a period of time, and as a result, PO gets satisfied over a period of time, and as a result, revenue has to be recognized over a period of time. Simple. Now look at this case too, you will understand the difference. Same music company, ABC company, licensed an existing album with no updates or changes during the license period. Let's say there are 6 songs in that particular album. Only that album license I gave you, that's all. Nothing. These songs you can use. There ends the matter. The streaming company gets static copy of the album, no dynamic copy, which means the moment I gave license, my transfer of control is done. Transfer of control of service is done. Therefore, PO is satisfied. Therefore, revenue can be recognized on day 1 itself, the moment access is given. The moment license is given. You understand the point? So therefore, this we will call it as right to use. You should not use the word right to access. Why? Because there are going to be no future changes. Na? So whatever that is there, the static content, you can use it for 2 years. That's all. So therefore, you should use the word right to use. Here, that is not the case. I can't say whatever the content is there, you use it. No, because the content is going to change. Therefore, I will use the word right to access. Right to access. Are you able to understand? So therefore, in the case of right to use, because the content is static, there's going to be no changes whatsoever in future. Therefore, the moment I gave you the license, the transfer of control of service is done. Therefore, PO is satisfied at a point of time. Therefore, revenue also will be recognized at a point of time. That's it. So only to understand whether transfer of control of intellectual property is happening over a period of time or at a point of time only, we have seen these two examples. Got it? Now let's revise. See here. Licensing can grant either right to access intellectual property over time or right to use intellectual property at a point of time. The revenue recognition pattern depends upon which of these applies. Case 1, right to access. In right to access, what happens? If the license provides a right to access intellectual property as it exists and evolves over time, the revenue is also recorded over time, recognized over time. All these three criteria must be met to call it a right to access. What are the criteria? The entity is required or expected to perform activities that significantly affect the intellectual property. Like you need to update the entire platform, you need to maintain the entire platform. Then the license exposes the customer to the effects of these ongoing activities, receiving software updates and all those things. The entity ongoing activities are not separate performance obligations, they are part of the licensee's essence. So tomorrow you're going to add one more song. Can I call it a separate performance obligation? No. Tomorrow you're going to add one more feature. Can I call it a separate PO? No. Everything put together forms part and parcel of the license that has been given. That is why we are using the word dynamic. Dynamic means all the changes are also included. So whatever that is going to happen in the platform, you will have license for a period of 2 years. Therefore, tomorrow I'm going to do something. Tomorrow I'm going to add one song. Tomorrow I'm going to add one feature after 6 months. Then can I say that that service, transfer of control of that service has happened today itself? No, it's gonna happen over a period of time. After 2 months, I'll upload something new. After 3 months, I'll upload something new. After 5 months, I'll remove something that is existing. After 7 months or 8 months, I'll upload again something new. You understand the point? Just like Netflix. You subscribe to Netflix. Netflix keeps on changing things. Adds movies, removes, adds content, removes. So which means, is it dynamic or static? Dynamic. So from Netflix point of view, what is that? When we buy, we get the license to watch it, and tell me, is it right to access or right to use? Right to access. Right to access. Netflix is a prime example. Prime also, anything. All the platforms are ever changing. They're dynamic in nature. So say for example, you'll have a normal content and then it becomes 4K. It keeps on changing. New features keeps on coming. You understand the point? So it is right to access. The Netflix, what you're doing, all the subscription, pretty much right to access. Got it? Right to use means, say for example, let's say, suppose you are making a movie and you wanted to use songs from an old Ilayaraja Sir's movie, for example. I don't think everybody will understand what I'm trying to say right now. Those who can understand, if you know, you know. Okay. So therefore, you want to use the song and you know that obviously you have to get the license. So you go and get the license over there and you say that I'm going to use it for another 2 years for whatever the movies that I'm going to make. Now here, if you take license of that particular album of Ilayaraja Sir movie, right, then that is right to use, because now no change is going to happen. It is just static. So that will be regarded as right to use, and the moment Sir gives you license, you can recognize the revenue. Who can recognize the revenue? Sir can recognize the revenue at a point of time. Got the point? Chalo, I hope this is clear. Easy peasy. Everybody, right? Shall we go for solving sums now? Yes, 69 and 72. Now, question number. Okay, come to question number 69, everybody. An entity, a music record label, licenses to a customer 1975 recording of a classical symphony by a noted orchestra. So I think this is static. Let's see. The customer, a consumer products company, has the right to use the recorded symphony in all commercials, including television, radio, and online advertisements, for 2 years in country A. In exchange for providing the license, the entity receives fixed consideration of 50,000 per month. Per month. The contract does not include any other goods or services to be provided by the entity. The contract is non-cancelable. Determine how the revenue will be recognized. Actually, it's a very easy question. The moment you see right to use, you know that transfer of control did happen at the beginning itself. Therefore, PO is satisfied at the beginning itself. Therefore, you have to recognize the revenue at the beginning itself. But, he's gonna pay you 50,000 per month. So this will create some problem. Let's say he says 10 lakhs is paid at the beginning itself. 10 lakhs revenue will be recognized at the beginning itself, isn't it? You understand the point? So now tell me how to recognize. First, transfer of control is happening over a period of time or at a point of time? At a point of time only, because license is given for that particular symphony. Which means PO is satisfied at a point of time. Yes. Okay. which means can I recognize the so-called revenue at the beginning itself? Yes. Then how much I need to recognize? That's the biggest question. How much? Now you people tell me. Tell me, Nana. Easy answer. Revenue recognized upfront at the beginning itself or over a period of time? At the beginning itself. Now the twist in this question, this also I've seen students doing mistake. You know what? They'll see this. They know the concept. They know that right to use means obviously it's going to be static, and as a result your transfer of control happens at the beginning itself at a point of time. So PO is satisfied at the beginning itself. Therefore revenue has to be recognized at the beginning itself. They have that clarity, but by the time they come to this particular sentence, they'll see, oh, you are paying 50,000 per month, which means we need to recognize revenue over a period of time. No, all the revenue will be recognized upfront. Total revenue will be recognized upfront. Monthly consideration means revenue over time. No, wrong. Somebody has given answer here also. Wrong. Total revenue will be recognized upfront. That's the answer. Clear? And remaining, you can just copy paste the entire concept of right to use. This you can copy paste. This sentence and all. That's enough. That will be your answer. Don't go through your IC answer. This is the answer. Total revenue has to be recognized upfront. Exactly. Clear? Are we done? Monthly payments is irrelevant, Nana. It has got nothing to do with things here. Your performance obligation is granting license, Nana. Is it granted? Yes. At a point of time, yes. The moment license is granted, you have to recognize the entire revenue. Clear? That we don't know, so you just write the sentence, total revenue has to be recognized upfront. That's all. Clear? So one student is asking, sir, that means 12 lakhs has to be recognized at the beginning itself, at the commencement. Yes. But your eyesight did not give you the answer, because if you look at the question, he has asked you how the revenue will be recognized. He did not ask you how much. So therefore, your eyesight did not mention the amount. But if you want amount, okay, 2 years into 50,000 per month, which means 12 lakhs. Will be recognized at the inception itself, at the commencement of the license itself, at the beginning itself, even though the real payment will happen over a period of time. So you will put it as receivables, that's all. Simple. Yeah. You understand the point? Clear? Shall we move on? Right. Moving on. The question carry. 72. Now come to question number 72, Nana. Question number 72. Ready? Okay. Sports team D enters, this is important and mark it as important. Okay. Sports team D enters into a 3-year agreement to license its team name and logo to apparel maker M. Okay. The license permits M to use the team name and logo on its products. Okay. Including display products and its advertising or marketing materials. Determine the nature of the license in the above case. Next. Modifying the above facts that Sports Team D has not played games in many years and the licensor is Brand Collector B, an entity that acquires IP such as old team or brand names and logos from defunct entities or those in financial distress. B's business model is to license the IP or obtain settlements from entities that use the IP without permission, without undertaking any ongoing activities to promote or support the IP. Very intelligent business plan, this fellow says. Would the answer be different in this situation? It's a good question. So now that you know that there are only two types of intellectual property license, one is right to access, the other one is right to use. Right to access means the kind of access that you get is dynamic in nature. Therefore, the transfer of control of service will happen over a period of time. Therefore, PO will be satisfied over a period of time. Therefore, revenue has to be recognized over a period of time. The other one is right to use, where you will be given a static content and the content will never change. Therefore, at the beginning itself, at the inception of the licensing itself, you have to recognize the revenue because PO is satisfied at a point of time. Clear? This is what the concept that we know, but that needs to be applied over here, and that's going to be very interesting. So I want you guys to just read the question. I'll give you some 30 seconds. After that, I will solve it. I'll take time and then I'll solve it. We'll look at the facts of the question slowly, slowly. We'll start it. Only then this will sit here. Otherwise, this question is a little bit, yeah, it will sting. It will sting for sure. Right. Read the question. I'll wait for 30 seconds. After that, we'll start. All right. Are we done with your reading? Okay. If you want my answer is very simple. Determine the nature of license in the above case. That is by reading these 3 lines. The answer is right to access. Right to access. Therefore, revenue will be recognized over a period of time. That's the answer for first part of the question. Second part we'll discuss later. Now, if I tell you something like this, can you understand? You can't understand anything. Sir, how, sir? Just by reading 3 lines, how are you able to come to that conclusion? I'm not able to understand. Then it means that we need to dig deeper. So let's start solving question number 72. Do along with me. Question number 72. Do along with me. Ready? So first we'll start with data from question, because based on that only, we need to analyze naturally. Let's start with data from the question. I want you guys to have question in front of you. What is there? Hardly it is 3 lines. You can easily remember also. Chalo, tell me. What's happening over here? You have sports team D. Yeah? Okay, this gives license. This fella gives license. Okay, what kind of license it is giving? Team logo and name. Like for example, let's say this is RCB. You can use that, okay, on apparel, okay, on display products. That's what now, advertising and marketing materials. A lot of people will buy, na? You understand the point? This is what is actually happening. And remember, the most important point is this team is active team. What do you mean by active team? It is playing. It's playing. Look at the wording. It is active because in the second case, he's saying that the same team has not played games in many years. Which means if you look at the first sentence, it enters into 3-year agreement to license its team name and logo to apparel maker M. The license permits M to use the team name and logo on its products, including display products and its advertising or marketing materials. Sir, here specifically nothing has been told the team is active. Yes, but you need to understand, use the smartness. Here, modifying the above facts. He's saying that this guy hasn't played anything. This team has not played any games in the many years, which means it automatically confirms the fact that here this team is playing games and it is active. This understanding is very important to arrive at the conclusion answer. Are you able to understand? So, even though here there is no clarity, but then by looking at this sentence where he starts with saying modifying the above facts, which means whatever the facts over here, for that this is opposite, and the opposite fact is this guy hasn't, this team has not played any games, which means here it has to play games. So therefore it is an active team. So if you can decode this, the problem is done. It's easy. If you are not able to decode this, then maybe coincidentally your answer can be right, but you did not apply the concepts properly. Once I finish off the whole thing, you'll understand the depth of what I'm trying to say. Anyways, clear? Ready? Okay, now tell me one thing. What is the intellectual property over here? Team logo and name. This is the IP. Now the next question is, what is the value of this IP? It is dynamic. Why value of this intellectual property is dynamic? Because the value of IP depends on team performance, isn't it? Suppose during that time only this guy has won, RCB has won what? The IPL Cup. Don't you think that their value will increase? Exactly. More and more people will buy. The apparel, display products, advertising and marketing materials will work. So when this team is an active team, it continues playing games, field competitive teams and brand visibility will be there. So therefore, it will significantly affect the value of the team name and logo, which the so-called Maker M is using on its apparel. You understand the point? Apparel, right? Clear? Remember, one thing where students get confused is that these activities, which are done by the active team by playing games, do not transfer goods or services to Maker M. But it affects the usefulness and value of the intellectual property. The more and more these guys participate, the more and more they are active, the more and more they are performing really well, the more and more the perceived value of this intellectual property will increase. Now tell me, so more and more these guys are playing, more and more it will increase means what kind of intellectual property you have got? Is it right to access or right to use? It is right to access. Why? Because here itself I gave you clue, it is dynamic in nature. Therefore, the answer is right to access. Now, when I say right to access intellectual property, naturally you people will tell me what happens because of this. PO is satisfied. Over period of time, naturally. So which means what you have to do? PO is satisfied over a period of time. Then revenue is recognized. Correct. Revenue is recognized over period of time. Typically, it will be straight line basis, Nana, for 3 years. Normally, on straight line basis, which means equally. Unless another pattern is given specifically in the question, otherwise it will be straight line basis. Did you arrive? See, this is what the thought process that went when I've read the question at the beginning itself. So I know that because in the second part of the question, he's saying that this particular team is not active and it is not playing games from many years, and he's using the word modified facts, which means obviously opposite should happen at the beginning of the question. That's the understanding. So therefore, the team has to be active. When the team is active, the more and more they perform, the kind of things that they do affects the perceived value of the intellectual property. So the intellectual property, if they have performed pretty bad, let's say 5 matches they have lost, then the perceived value of the intellectual property will fall. You understand the point? And then after that they starts winning, then again this will increase. As a result, the sales will increase. You understand the point? So therefore, it is dynamic in nature. Because depending upon in future what these guys will do, what kind of matches they'll play, how they'll perform, depending upon that, your value of the intellectual property keeps on fluctuating. So therefore, it is right to access because it is dynamic. The moment you see a situation where things are dynamic, you should use right to access. And therefore, the transfer of service will happen over a period of time because the performance will happen over a period of time. Therefore, performance obligation or performance satisfaction, PO is satisfied over a period of time. Therefore, revenue will be recognized over a period of time. In this case, it is 3 years. So over a period of 3 years, it will be recognized. Clear? Right. So this is the answer for first part of the question. Very interesting. That's why I said this problem is important. Now let's come to the second part of the question. I think some of you have already got the answer. Okay. So what's the situation? Sports team D. What's the situation? Has not played games. Inactive. Okay. And who is the licensor in this case? The one who has got the license. Brand collector B. In real life also, there's a guy like this who collects all the acquires old and defunct brand names. Classic Legends. I don't know whether you guys know or not. Classic Legends comes under Mahindra. These guys keeps on buying Java, SD. Are able to understand? BSA, all these old brands, defunct brands are being bought by these guys, and then they try to, relaunch them again. You can see that's why you go to Java showroom, you will find bikes with respect to all the 3 brands: SD, Java, as well as BSA. Right? So, anyways, in real life, Classic Legends is a perfect example. Like this guy, brand collector B. So, what this guy does is, what this guy does, acquires, if you look at the question, old or defunct brand names or logos. In this case, we need to understand that this sports team D comes under this category because they are not playing games. So, they are old or defunct and they have been bought by brand collector B. So, he gives the license now. Clear? Hello? Yes. So now this license is given to this Moku fellow, Maker M. Now tell me, because this team is inactive, are they going to perform anything? No. Because of that, when they are not performing, when they are not being seen outside, will that change the perceived value of the intellectual property that you have bought right now by Maker M? No. Are you able to understand? Direct marker. Maker. You got the point? So there is no ongoing activities. So that will not affect the form, functionality, value of the intellectual property and all those things, which means it is static. The perceived value of intellectual property in this case is static. Character fixed existing brand name or logo. That's all. IP exists as it is. So customer benefit, customer is nothing but licensee, Maker M. Customer benefit is not dependent on future actions because there are no future actions. You understand the point? In that case, it will be referred as right to use. Right to use. So obviously, at a point of time. So what will be your answer? PO is satisfied at a point of time. When PO is satisfied at a point of time, what will be your revenue? Revenue is recognized when license is. Which means at the instance of contract. It's a very, very, very good question. So you can answer these kind of questions only if you're conceptually strong. Okay, so you need to understand, okay, fine. If these guys are not playing any games, then they are not going to do anything in future, which means whatever the value that you get today by getting the license, the value will remain exactly as it is. So nothing is going to change in future. It cannot increase, it cannot fall down. So therefore it becomes static. And as a result, it is right to use. And therefore, the moment the license is granted, immediately you can recognize the revenue because PO is satisfied at a point of time. Very, very, very beautiful question. These are all the kind of questions that actually needs to be asked at final level. Okay. But sometimes that's okay. Anyways, did I say it does not make these kind of questions nowadays? In IFRS, you will find these questions pretty well. Right? Are we done with this? Shall we move on? Right, that's it.